This conference will now be recorded.
Thank you for joining me. My name is Steve Tuttle, and I'm a partner and portfolio manager for Signet Financial. Today, we're going to be talking about investing through adversity. The environment after a decent start to the year has deteriorated. Third quarter was a very strong quarter for equity investors. October has started off the fourth quarter in a very negative way. And as a result, now year to date, we're negative for most asset classes year to date. And there's three common explanations for this downturn. The first is fear that the global economy and U.S. earnings are peaking. Trade wars between the U.S. and China are definitely a factor playing a role there. Another concern is that the Fed may be committing a policy mistake and over tightening. They continue to hike rates, and there's some concern that perhaps the economy isn't growing fast enough to warrant further hikes. And lastly, and this is the reason that I put the most credence on, it's that investors may be overreacting to this late cycle environment. Certainly, the bull market is been going on for about 10 years, and corrections are inevitable from time to time. While it's true that market conditions have become a little more complicated in recent months, we don't believe that the bull market is over completely. So is the bull market over? We think the answer is no. The economic recession does not seem likely in the near term. Corporate profits are still strong, and we think they're going to continue growing next year, perhaps at a slower pace, but still growth. And we think these two combinations of factors will help stabilize markets for investors. Another consideration is that as the Federal Reserve continues to unwind monetary policy and hike rates, it shouldn't be a complete surprise that risk assets have come under pressure. So basically, volatility is a normal occurrence that should be expected in markets. So let's get back to my point that 2018 looks like a year of overreaction. We don't think the end game needs to be priced in now. Essentially, markets are forward-looking, and it's natural to discount slower growth at this stage in the business cycle. However, we think it's just a bit too early to turn overly defensive in your investing, and we acknowledge it may be harder to achieve returns looking forward, but through active management, discipline, and patience, we think there's still opportunities out there. So let's try to put some things in perspective regarding the pullback that we've seen so far in October. It's true times like these require a bit of an iron stomach. Over short periods of time, markets can and do move up and down, sometimes violently. Over the long run, it's very important to remember that markets tend to move higher. So what I'm showing here is a chart that shows the number of 5% pullbacks in the S&P 500 each year. You see last year, zero, no volatility at all, essentially. This year we've seen 5 pullbacks of 5% or more in the S&P 500. And looking back over history, that number is certainly not unprecedented. In fact, it's probably right around the average. Another important point is that there's a big opportunity cost of being out of the market, even if you're anticipating or trying to sidestep a bear market. So this chart is pretty interesting, and essentially what it does is it shows the returns of markets in the periods before market tops. So if you were to exit the stock market 12 months prior to the start of a new bear market, so bear markets don't happen very often, but they happen. So if you were to guess right, get out of the market 12 months before that bear market started, well, you missed out on about a 23% return. If you got out 6 months, it was a 15% return. If you got out 3 months prior, so your timing was pretty accurate, you missed out on an 8% return. So the point, again, is that being a little early and trying to sidestep bear markets, even if you're late in the business cycle, as we believe you are right now, there's still a significant opportunity cost of doing so. Now, one of the reasons that we are comfortable staying invested through this, what we consider a temporary correction, is valuations. And here's a slide from J.P. Morgan, which shows the average PE ratio of the markets, forward-looking, is right around 16 times earnings. And going into October, we were just above that average at 16.8 times. With the correction that we've seen so far in October, combined with strong corporate earnings, that PE is now below the historical average at around 15.5 times. And to us, this is an encouraging sign. So how do we handle the volatility? Well, one thing I want to remind all of our clients and investors out there is that bonds are a pretty effective tool for managing volatility. Here's an interesting slide which shows during periods of downturn in the S&P 500, how have bonds performed. And so this slide compares the S&P 500 during down periods compared to the Barclays U.S. Aggregate Bond Index. And you can see in each of these periods of time, stocks are down, bonds are up, sometimes more than others, but they do provide a nice buffer for equity volatility. So I'll end with a few thoughts about how to increase investing success and how to put yourself in a better position to achieve your goals. First and foremost, it's important to determine which strategy works best for you. And this is where we spend a lot of time with our clients. I don't believe there's one strategy that works for everybody or one strategy that's far superior to all others. It does come down to your comfort level, your needs, and your expectations. And it's important to have a plan that you can stick with through the ups and downs that the markets throw at us. Don't try to predict or time the markets. We found that's fruitless, and no one can predict the timing of stock market corrections with any certainty. Another key point is to focus on what you can control. We can't control returns in the short term, but we can control at your allocation, how your portfolio is invested. We can control your savings to some extent. We can control your expenses to some extent, and we can control your risk level to some extent. So these are all things that we can help you with. A few other tips: be opportunistic. I like to view pullbacks as opportunity. Because we're long-term investors, we can use short-term volatility as an opportunity to upgrade our portfolio, and we're looking and finding opportunities like that right now. And lastly, be patient. Market performance is unpredictable. As I just went over, we can't control it. But even the most successful strategies are going to go through tough periods of time. Expect it. But if you stick with that plan and it's well designed, you should end up in the position that you need to achieve your goals. So a few final thoughts. When markets fall, it's normal to worry. The thing is, and this is the tough part, it's also very normal for markets to go up and down. So again, expect that. When we're going through inevitable periods of tough returns, it's very important to stick to your well-designed plan. That's the best strategy that we've found for our clients. In terms of opportunity, if you've been sitting on any cash, if you've been waiting for a better opportunity to invest, well, now might be a great time to consider that. So look at this pullback as a long-term opportunity, and we can help you with that. If, on the other hand, you've done very well in markets over the last few years and you're deciding that you don't want to be in the markets as aggressively and these short-term gyrations are too stressful, again, we can probably help. Let's talk. Have your circumstances changed in a way that alters your ability to withstand these ups and downs? Is there a way to smooth out the bumps? Perhaps there is. We have some interesting strategies. And how much risk is prudent to achieve your goals? These are all factors that should contribute towards any changes that you would make in your portfolio allocation. So it's real important that you speak with us and we discuss it intelligently and with evidence and make some decisions together to help put you in a better position. So I want to thank you for your time and continued trust. As always, you can reach out to me by phone or email. They're on the screen right now. I'd also encourage you to follow us on Twitter at Signet Fin. We put out a lot of interesting material that's very educational and sometimes entertaining. So I thank you again. Have a good day.